I'll add one real quick. One of the things that we constantly battle is if you've got a really interesting, compelling business concept and idea, generally speaking, there will be lots of potential threads for you to pull apart, that different silos that you can go down with this business. And focus, and discipline, and prioritizing what you're going to focus on is always a challenge.
Greg, before you make your comments, anybody else has a question that you'd like me to ask the panel? Just if you would raise your hands, I'll walk around, I'll let Greg answers, and I'll get you on. Go ahead, Greg.
I'd like to start by asking a question of my own. How many people in the room have actually invested their own money in a private business as an investor? Okay. How many of you have done it more than once in the past 3 years? How many have done it and are never going to do it again? There are a lot of liars in this. Very disappointing. Common mistakes. I had to write them down. There are so many. This is the entrepreneur's mistakes. Didn't do homework on investor market, capital market. Investor market / capital market. Okay, they didn't do their homework. They don't know the market they're asking for the ask from. They're ignorant about acceptable deal terms in our market being our market, the angel market here in Louisville. They rely on AVCA documents, American Venture Capital Association documents, written by California law firms that are too issuer friendly. Okay, I'd love to talk to you about that for about an hour someday. Documents are not all created equal. If you're going to do deals in this market, you better have documentation that fits this market, not Silicon Valley. Entrepreneurs are sometimes ignorant, not to say stupid, but ignorant about distribution and tax issues that are faced by their investors. You ever want to see a deal held up over a couple of sentences? Focus on the distribution language. Entrepreneurs are sometimes overly optimistic on their projections and valuations. I'm sure none of us have ever seen that before, right? They frequently make unrealistic demands about board composition and voting controls. This is what Mike just alluded to. Corporate governance is, besides management talent, probably the most important issue that we face, because when the you-know-what hits the fan, it's all about who's on the board and what are they willing to do for the investors. A lot of entrepreneurs use stupid, overused buzzwords. Okay? We've all heard them, we all know what they mean. Please, try something original. Angels are not to be confused with pushovers. We could all spend an hour on that topic as well. Lower your expectations about ownership, the time it's going to take you to get to market, and your own value to the enterprise. You can be replaced. It's really hard to replace your investors. Assemble an experienced board, please. And that's just a few.
I really think that was an excellent list, and I'm going to be much simpler in my comment. I think that I heard from an investor. He said, these are the 4 things that I look for as I make my investments. Number 1, I have to know the person individually. I have to know that person. Number 2, I have to know that person to be of high integrity and good character. Number 3, I need to know that that person's net worth is completely tied up in this particular investment, their endeavor. And 4th, they have to have an attitude of win at all costs or die trying. And I thought it was a great summary of what it is that some of us would look for when we look at the management team. You talked about the jockey horse. I think it's just a great way of saying it. One of the things that I think investors, entrepreneurs forget is that when they're looking for investment, they're selling part of their company. Sometimes it's funny, but just that changing the way we're buying into your company, you're selling part of your company. And so to think about who you want to be part of that company. Do I want kind of a board? Do I want all the very excellent things that have been mentioned? So I'll just stop there, but it's a wonderful thing, but we are careful about both sides of it. You should be careful about who you're choosing as investors if you're an entrepreneur. just as the investors are careful to pick entrepreneurs and back entrepreneurs that they think have a real chance of making it.
I had a quick question. Greg mentioned feeding the children, and maybe from each of you, what multiple of follow-on do you carry? When you're dropping 25 grand or something in, do you either mentally or formally set aside X dollars in funds as the expectation of what you might have to put in to keep something alive?
From a fund management perspective, we have a specific allocation to where if we were to raise $100, we'll make initial investments comprising only about 50% of that $100, and then we'll hold the balance back for follow-on investments. And we've, not unlike Greg, we've made multiple follow-on investments in companies that have done well and companies that have done poorly. So it's you always got to have dry powder. And part of the challenge for the size companies that we invest in is as they grow and they mature, the next round of funding may be a more institutional round, like a Chrysalis Venture, where Chrysalis is going to put $5 million in or wants to allocate 5 or 10. Right, Elizabeth? So part of the logic that we want run through is, do we want to be funding and making capital calls on a going forward basis? If they're putting $5 million or $10 million into a company that we've grown from $1 million in sales to $15 million in sales, they're going to take it from 15 to 50 over a 3-year period. They may get it to 50 in 3 years, but instead of going like this, it may go like that. And if you can't maintain your position as an investor, you get wiped out, and you took what was a really good investment with a really nice return, and you just washed it out.
Before we go to the next question, if you have a question, let me just see your hand real quick. I want to get a feel for how many we have in the room here. Okay, I'm going to go there, 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 and there. So.
My question, Pete kind of started is, and I think Bill kind of mentioned, what projects do you not like?
Me? Medical devices, real estate, anything I can't understand.
I would, things that I don't understand, which is a broad spectrum of opportunities, and essentially consulting-based businesses.
We don't like retail. We don't like real estate because you can do that on your own through any other kind of vehicle you can imagine other than our fund. So there's plenty of opportunities for you to invest in those things. I love to eat, though, Mike. So, we do like medical devices. We've done well with that asset class. But our general marching orders are that since we have such a diverse and talented group of members in Anchorage Angels, that we rely on our members to bring us deals and perform a lot of the due diligence. So if we've got domain expertise within our membership, we lean heavily on that, and sometimes those individuals will actually be the lead investor in the deal, and they'll carry the burden. So it's an opportunistic approach. Very, very few businesses are off limits other than the broad categories of retail and real estate.
One of the things that we shy away from, particularly in this environment right now where credit is very difficult to get for small young companies, are companies that are going to have significant inventories and or significant receivables. For the size funds, and we tend to invest in $1 million rounds. If you've got a really fast-growing business, that can be very challenging in being able to keep up with that type of capital requirement.
This question for anybody on the panel: how do you feel, or how do you deal with entrepreneurs